Yes, we are live. Can start.
Yes, sir. Can I start? Yes.
Yes.
Good afternoon to all CA students and also our faculty, Mr. CA F Jaison, sir. Welcome you, sir. And he is known by renowned faculty in South India, and he is teaching accounting for CA inter students and also financial reporting for CA final students. And he has taught more than 30,000 plus students, and he has produced prolific chartered accountants. He has been associated with SIRC for a long time, and he teaches at ICAI branches and is referred by accounting guru for many students. SAR is motivation to number of students and also mentor to many qualified and chartered accountants also. Welcome you, sir, to the revise and recall session marathon, which is conducted by SIRC.
Thank you.
By SICASA, sir. Yes, sir. Now I request all the students to be patient till the end of the session and watch the session. And also I request all the students to post their queries in a comment box, and I will deliver it at the end of the session to the sir. Now I hand over the session to CA F Jaison, sir. Please take over, sir. Thank you.
Okay. Thank you, my dear friend. Rahul, no?
Yes, sir.
Okay, thank you. So thank you, SICASA, as well as ICAI for arranging this program. So I was informed yesterday about this schedule. So this schedule or this program is titled as Approach to CA Inter November 2022 exam, and it is paper 1 of group 1 accounting. So similar programs has been arranged in the past, which I have handled, which we normally take for 30 minutes per subject, discussing purely from the perspective of what to be done a day before the exam, as well as the presentation part of your paper. Now, this is a 3-hour session, so it is not just to discuss like presentation and all, and it is all the more felt like over again and again discussing only a presentation aspect from an examination perspective to a student who is grown up, cleared foundation, and attempting the middle level of a professional course. So definitely all are having the ability to make wonderful presentation. But still, in spite of it, we can spend last 10 minutes or so for the presentation segment of this paper. So I will just take it in a wider perspective. It is something like 240 hours of regular coaching getting crashed into 3-hour session. So I will put it that way. So which means, are we going to recall or revise all the chapters? May not be, but we are trying our level best from the coming examination perspective. So immediately you should not be expecting like, oh, sir is going to tell important chapters. Normally that was a trend, whether in school or in any examination, we always expect important questions, important chapters and all. At a professional examination, there is nothing called important questions or important chapters. And all the more, if you analyze the last number of question papers, maybe like 8 to 10 question papers of CA intermediate level, examiners are smart enough and they are covering all the chapters. So when the accounting was subdivided into group 1 and group 2, now there is a luxury to cover all the chapters in the paper for 125 marks. Your paper is for 125 marks. So they are actually covering all the chapters. And care has been taken that significance is given to each and every chapter. Every chapter covered will come for 8 to 10 marks. So exceptionally, they focus on one single chapter, which comes for a 20-mark question. Other than that, there is an equal distribution of marks to almost every chapter. So in the present trend, we cannot have any selective study like selecting few chapters saying it is important or not. Maybe in the new curriculum, what institute have proposed, where again accounting and advanced accounting will be combined, and they bring all these 24 chapters into a single subject. Possibility are there that maybe again selected studies will come. We don't know. Anyway, that's not our topic of discussion. So let's quickly go to the core agenda of our discussion, my dear friends. We know that your study module our study module, my dear friends, accounting paper has got 4 modules. We have module 1, module 2, module 3. Apart from that, we have pronouncements. From an examination perspective, word to word of the pronouncement, you need not study. Actually, you have accounting standards, which is given as pronouncement of the institute. So for a detailed understanding, conceptual clarity, for practical purpose, one can go through that. Otherwise, generally not required, at least during the last few days of before the examination. If at all you should have studied, it should have been done right from day 1 onwards, not now. So that is not required. If somebody asks me, should I study pronouncement? That was a regular question I used to get. So that is not required from the last 2 months preparation perspective for examination. So we are focusing on module 1, module 2, module 3 of our accounting paper. Module 1 has got 3 chapters. So similarly, module 2, my dear friends, we have actually in the chapter wise, if you look into it, it's only 5 chapters, but I consider there are 6 chapters. In that module, financial statement of companies and cash flow statement has been given as together in a single chapter. From our teaching viewpoint, we always consider these 2 as independent chapter. One is based on one of the accounting standard, and thereby I will say 6 chapters we have. I will list out what are the chapters, how to approach each of the chapter from an examination perspective. Similarly, module 3 has got 6 chapters. So that way we have 15 chapters from an accounting paper examination. We have 15 chapters subdivided into or segmented into 3 different modules. In module 1, my dear friends, we have 3 chapters, which is one is Introduction to Accounting Standard. Introduction to Accounting Standard, which actually explains the history and geography of accounting standard. Who issue accounting standard, relevance of accounting standard, significance of accounting standard. In a regular session where we take hours and hours of classes, and for practical reasons also, we feel that this chapter is very, very important. You should definitely be aware of who issue accounting standard, what is the standard setting process, Ind AS means what, IFRS means what, so when is the applicability of Ind AS, like that, several things we discuss in that chapter. But again, analyzing the 10 papers of CA Intermediate Examination Accounting, we find that not even a single question comes to the examination. So today's discussion is not like which is to be very important from a practical aspect and all. So it is purely from an examination approach. So I normally, as a student, I don't take at the preparation viewpoint is chapter 1. So I don't give much relevance there for Introduction to Accounting Standard. Chapter number 2 is called one document which is called Framework for Preparation and Presentation of Financial Statements. Last 3-4 papers, if you analyze, at least 5 marks and sometimes even 10 marks coming from this document. A framework, a theoretical topic is what people see, but has got a lot of practical applications or number-based problems. Framework. So we'll discuss some relevant things because out of last 4 paper, we had a lot of good questions in the December 2021 exam, July 2021 exam, but May 22 we didn't have. There is a chance that you have a lot of significance from this topic in the coming examination. We will discuss some relevant aspects here. Similarly, we have overview of accounting standard and we have 8 accounting standard. At intermediate level, totally we have 21 accounting standard for the total syllabus, 13 accounting standard in group 2, and we have 8 accounting standard in group 1. Now, just quickly telling you the relevance of this, my dear friends, if you're going to prepare very rigorously from now on, accounting standard is something that you can't miss out. You should spend extra time because in group 1, in the last examination, if I analyze, I find 30 marks, 30 marks coming from accounting standard, number 1. So it is very significant mark. Number two is that if you ignore any single chapter out of the remaining chapters, still a student can attempt 100 marks. But if the student ignore accounting standard, definitely 20 marks they can't attend, because again the trend of question paper shows that question number 1 is mandatory. Answer any 4 from the remaining 5. So totally a question paper will consist of 6 into 20 marks. 6 into 20 marks. 120 only, why do you say then 125 marks? In the question number 6, which is again 4 into 5 breakup, is out of 4 into 5 out of 5 into 5. So there is an internal choice of 5 marks. That way your question paper is generally made up of 125 marks. Now, so you have a choice for 20 marks, and this choice is not applicable for accounting standard. Accounting standard question is mandatory. So if you're ignoring accounting standard, then maximum you can attempt the paper only for 80 marks. So thereby, 2 things. One is this is very significant contribution to this paper. Number 2, it is mandatory question. So thereby, a student should focus or spend a lot of time onto these 8 accounting standards, my dear friends. And it's not merely 20. First question, again 4 into 5, 20 is accounting standard. Question number 6 also is 4 into 5, 20 marks. Out of the 4 questions, again 2 questions can be from accounting standard. In group 2, we have 13 standards, so you will be blinking like which standard will come. But in group 1, it is not so. So because 8 standards you will have, and you are expected to have 6 questions, so definitely 6 out of 8 standard means definitely it is worth spending a lot of time on to accounting standard, my dear friends, in group 1. Okay, so this is the significance of module 1. So we will spend later on, we'll spend some time on the framework and accounting standard, or a lot of time today we are going to spend on to this framework and accounting standard, because it's not easy to cover chapters, my dear friends, at this point of time. So chapters from the beginning, end and all, we'll just give you some hints and guidance for covering various chapters. So in module 2, which is primarily of company accounts, or we call it corporate or company accounts, you have financial statements of companies, cash flow statement, profit or profit prior to incorporation, profit or loss prior to incorporation. You have bonus issue, then 2 redemption chapter, redemption of preference share capital, redemption of debentures. So these are the 6 chapters we have in module 2. And in module 3, we have insurance claims, investment accounts, hire purchase, branch accounts, departmental accounts, and you have single entry. So these are the 6 chapters in module 3. Anyway, so if you analyze this, my dear friends, I told you from this module 1, you will have generally 30 marks out of 125 marks, my dear friends. And from this investment, hire purchase, branch also, we are finding, my dear friends, lot of marks. In the sense, around 55 marks I'm finding in this. So only 40 marks from this and 55, and sometimes there will be difference. So this is the significance of the normal question paper in my analysis. Now, normally, when faculties at the end of class used to tell this chapter is very important for the coming examination, it's not any 7th sense. Any student can do this. So thereby, please don't believe on any important question or any important chapters. Only common sense that lies behind is that, though it is not a rule, though it is not guarantee, it is risky only, but still common sense wise, psychologically, what question came in the last examination or huge significance given in the last examination will not have same significance in the subsequent examination. Example, in the last examination, we have a shocker. It's not shocker, it is a gift, but people took it as shocker. Profit or loss prior to incorporation came for 20 marks. People, and it is a study material problems students should have taken as gift, but many felt only profit or loss prior to incorporation comes for 8 marks, came for 20 marks, and mind is blocked and they couldn't do it properly. So there are several students, some students have done it superb. So sometimes like the shocker will come. Otherwise, my dear friends, normally there will be an even out distribution. So which means in the coming examination, we don't expect again another 20 marks for profit or loss prior to incorporation. examination prior to this previous examination, we had an investment account chapter coming for 20 marks. Even prior to that, we had redemption chapter coming for 20 marks. But that redemption was redemption of preference share, redemption of debenture, bonus issue, combined, asking several journal entries, 20 marks. Like that, institute sometimes give shock, but otherwise, more or less, there will be an even out distribution. Anyway, so as I told you, my dear friends, today my core discussion will be on to the module number 1, which I feel mandatory and students should not be missing out. Number 3 is easy to secure, my dear friends. So let me proceed on to this module 1 discussion, my dear friends. To start with, in module 1, I told you introduction to standard, like, that history, geography or standard not required. We usually do in a regular class. In regular class, it's very vague. So we start with module 2, my dear friends. There is a document called framework. Framework for the preparation and presentation of financial statements, which is actually one of the pronouncement of the ICAI, which guides different people who are interested in financial statements, like auditors, preparers of financial statements, users of so many people can use this guidance for understanding financial statements. So framework for the preparation and presentation of financial statements, which has got few areas. I will discuss the core areas, my dear friend. Discuss about what is financial statements. Then it discuss about what is the purpose of financial statement? Why do we require this financial statements? Then qualitative aspects, characteristics, or it is also called as qualitative aspects of financial statements. Then we have fundamental accounting assumptions. Then that framework has got, my dear friends, elements of financial statements. See, actually, you learn hundreds of chapters in accounts, but accounts can be compressed into 5 items, 5 elements: asset, liability, income, expense, capital, which we technically call it as equity. The term equity means owner's fund. So any chapter, hundreds of chapters or thousands of transactions, everything can be compressed into 5 items only: asset, liability, income, expense, and equity, which is what we call it as elements. So this framework defines these components and also prescribe the recognition criteria, general recognition criteria. Then this framework discusses about few other things, my dear friends, which is measurement basis, and it also discusses about towards end concept of capital maintenance. Now, my dear friends, in the recent RTP, we have a question from this fundamental accounting assumption I want you to solve. You know what are fundamental accounting assumption? Going concern, consistency, and accrual. We have going concern, consistency, and accrual. These are the fundamental accounting assumption. Sir, it seems very primary discussions at an intermediate level. Yeah. Now let me quickly go into the area, my dear friends, from going concern. So we had one question already tested. It's like 3-4 examinations before. So one more time it can come, my dear friends. And that time it came not merely for 5 marks, it came for 12 marks. So what was that question based on going concern? Means, my dear friends, simple. If there is going concern, we follow all the accounting standards as it is. If there is no going concern, then assets and liabilities are to be recognized at realizable value and settlement values. Realizable value and settlement values. Already in the books, it is having some value. Suddenly, business feels that there is no going concern. But you should find out various realizable values from the assets, settlement value of liability, difference between book value and such realizable value or settlement value should be recognized as gain or loss. For example, we have machinery. The question giving you machinery, which is having a value of 6 lakhs, remaining useful life 6 years. So it also states that today, if the machinery sold in the market net sale value. So if I sell in the market, I will be getting 5,70,000. I'll be getting 5,70,000. So if this is the case, then question asking you, what is the balance sheet effect? What is the P&L effect? So if you present P&L, what is the value? What is the value in the balance sheet? If there is going concern, if there is no going concern. So very simple, my dear friends. So from a balance sheet perspective, going concern is there, no going concern. If there is going concern is there now, machinery, which is having a value of 6 lakhs, will be deducting based on the useful life depreciation 1 lakh. So we will be showing the value in the balance sheet 5 lakhs. Similarly, if there is no going concern, means machinery which a book value of 6 lakhs expected to show at realization value, which is 5,70,000. So the difference between book value and the net sale value will be recognized as a reduction from the asset, and these two amounts will go to profit and loss account, debit side. So this is the concept, my dear friends. So similarly, if you had some deferred expenditure, which will be amortized over certain number of years, which will be given in the question. So deferred expenditure 3 lakhs to be amortized over 4 years. Then 3 lakhs divided by 4, 75,000 you will reduce, you will charge it to P&L. But if there is no going concern, deferred expenditure means it is not creating any asset. For the purpose of accounting, we feel it is expenditure relating to several years. But this can be considered if there is only going concern. Otherwise, it has to be zero. Entire 3 lakhs should be charged in the P&L. So same is the case for value of stock, my dear friends. Value of stock. As far as stock is concerned, suppose, my dear friends, it is like this. We have cost to price 4 lakhs. Market price, my dear friends, suppose it is 3,50,000. Market price it is 3,50,000. Then if there is going concern, we'll be showing at 3,50,000. If there is no going concern also, we will show only 3,50,000. But suppose, my dear friends, market price is 4,30,000. Suppose market price is 4,30,000, then we will show stock at only 4 lakhs by applying AS to cost or NRV, whichever is lower. So cost is 4 lakhs, we will show only 4 lakhs. But if there is no going concern, all the assets are to be shown only at realizable value, which is 4,30,000, and you will book a profit of 30,000 in the P&L, even though it is not sold. So can I book unrealized profit? Yes, it will be accounted if you assume there is no going concern. So based on this, they have given few assets, few liabilities. From a liability perspective, it was given like this. There is a liability of 6 lakhs, my dear friends. Now, there is prepayment penalty for this liability, 5%. Interest rate 10%. There is a prepayment penalty, 5%. So what is this prepayment penalty? If the loan is to be closed before the original tenure of the loan, some penalty has to be paid. So in that case, if there is going concern, show the loan only at 6 lakhs. But if there is no going concern, settlement value of the loan, which is 6,30,000, and we will be showing a loss of 30,000, my dear friends. So this is one area which can be tested, which is there in the latest RTP, my dear friends. So I want you to definitely consider that problem from the RTP, which is also there in the study module, my dear friends. So anyway, I don't want to take the entire problem here for the purpose of solving. Yeah, framework. So this was the problem that had been given in the RTP. In the framework, my dear friends, they have given opening balance sheet, and they have given remaining life of PP is 8 years. Then NRV of the PP is given. So which means, my dear friends, they are asking, you are required to prepare not assuming going concern. So they didn't ask at least two. They asked you only one, not assuming going concern. But thereby, this 8 years information becomes irrelevant. So we should consider only 3,25,000. So opening value is 3,60,000. In that case, the difference between these two is what will account as depreciation, the P&L. Like that, based on this principle, what I just now taught you, you should be applying to this particular problem. So please definitely consider the solution also. There is a prepayment penalty. So every adjustment in that way I discussed. So don't expect me to solve each of the problems on the RTP, my dear friends. Then it requires 10, 12 hours and all. So this is very, very important segment from the framework, my dear friends. Okay. Then in the framework, there is based on accrual concept, one test is made. Accrual concept. Based on the accrual concept, you know that, my dear friends, income is accounted not based on the receipt the moment it is accrued. But there is also another concept called cash concept. As per cash concept, income is accounted only when the cash is received. Only when cash is received. It gives an example like this, my dear friends. Purchases for cash, it is 50,000. For credit, it is 3 lakhs. This is the purchases, my dear friends. Entire goods sold. Sales for cash, my dear friends, it is 2,20,000. For cash, it is 2,20,000. For on credit, my dear friends, it is or 3,20,000. 3,20,000. On credit, it is 1 lakh. Credit, it is 1 lakh. So question is asking you, my dear friends, profit or loss under accrual concept, under cash concept, under accrual concept, under cash concept. So if you follow accrual concept, my dear friends, the P&L will show total sales of 4,20,000. Total purchase. There is no closing stock. All the stock sold. So purchase of 3,50,000. Hope all of you applying your mind. So profit is 70,000. So this is accrual concept. All the goods purchased fully sold. Even though some portion of money yet to be received, doesn't matter. Similarly, some portion of expenditure yet to be paid, doesn't matter. Expense incurred, income accrued. So you have to account it. But if it is cash method, means in year one, you'll be accounting only that portion of sales actually received in cash, which is 3,20,000. Sales received in cash, 3,20,000. Purchases, only that part of purchase paid in cash to the extent of it is 50,000. So it shows a profit of 2,70,000. Then in year two, assuming whatever credit of this year will be paid and realized in the next year. Year two on cash basis. So this credit transaction will be subsequently received in cash. So second year sales will be 1 lakh and purchases will be this 3 lakhs. That time only we are going to pay. So it shows a loss of 2 lakhs. Loss of 2 lakhs. This is cash concept. Like this example is there. 5 marks, it can also be tested from the framework. So going concern one area, accrual concept one more area, my dear friends. Okay. Then elements of financial statement: asset, liability, income, expense, and equity. These are the elements, my dear friends. You should know primarily relationship between asset, liability, and equity. What is the relationship? Assets minus liability equal to equity. Asset minus liability equal to equity. Like that, it defines the relationship, my dear friends. Sometimes what happens in one of the question is giving asset information, liability information, equity, opening information given. Suppose 10 lakhs, 4 lakhs, and this is 6 lakhs. And it is giving few transactions, asking you to analyze the increase or decrease taking place in these items. For example, my dear friends, it is salaries paid in cash. Salaries paid in cash. it is 1 lakh. Salaries paid in cash, 1 lakh. So from asset liability approach, what is happening now? 1 lakh reduction in asset, 1 lakh reduction in asset. Liability, no change. So we find that this becomes 9 lakhs and this becomes 4 lakhs. So 9 lakhs minus 4 lakhs, equity becomes 5 lakhs. Equity becomes 5 lakhs. So you also have definition for expense and income. You know what is definition for expense income? It says that expense means outflow. There are three features. It is outflow resulting in reduction in equity other than payments to owners, other than distribution to owners. Three conditions makes a transaction as expense. What are the three conditions? Outflow or reduction in the value of assets. So primarily outflow, number one. Number two, reduction in equity. Number three, because every outflow is not involving reduction in equity. For example, suppose you had a creditors of 1 lakh paid in cash. In that case, what happens? Asset will reduce by 1 lakh. Liability also will reduce by 1 lakh. So this is 9 lakhs. Liability will become 3 lakhs. 9 minus 3, it is still 6. Even though there is an outflow, but equity remains the same. Outflow alone not sufficient. There is an outflow, reduction in equity, other than distribution to owners. For example, the third feature example is that suppose you pay dividend. I'll be a little fast because it's a revision class for entire chapter. So dividend payment, my dear friends. So what if dividend is paid means it is reducing only assets. It is outflow. Yes, sir. Condition satisfied, outflow. It is not reducing liabilities, sir. Equity reduces. Yes, sir. Equity reduces. Are all conditions satisfied? No, because it was a distribution to owners. So then it is not expense. So three conditions cumulatively satisfied to make it as expense. So from the definition perspective, they will ask you to analyze the relationship between asset and liability. What is the feature for an expense? Outflow, reduction in equity. It should not be distribution to owners. Similarly, income definition. This is an area people generally ignore in the classroom. Framework, just leave it. Suddenly 10-mark question comes, 12-mark question comes. No, people then only think, oh, framework is there, like that one chapter is there. That is why we are spending on this 3-hour session, that particular chapter. So similarly, income, my dear friends, inflow, increase equity other than contribution from owners. Inflow, increase in equity other than contribution from owners. Like that, there is definition for income expense. So the question might require you to analyze on the impact on asset liability equity and tell you whether it is resulting into income or expense. Ask you to identify whether it is income or expense. For example, if you issue shares and get cash means what happens now? Cash increases. Liability does not increase. Inflow, equity will increase, but it is a contribution from owners, so that is not income. All the conditions should be satisfied to make it as income. Commission received in cash. Cash increases, liability not changing, equity increasing. It is not a receipt from owners. So in that case, that is an income. Like that, you are understanding, my dear friends. That is also over. Next, measurement basis. They will give you value of an asset. There are 4 measurement bases, I would say. Historical cost, current cost, realizable value, present value. I purchased one bike for rupees 1 lakh. 1 lakh. So I purchased one bike for rupees 1 lakh. Upon that original cost is what we call it as historical cost. 2 years over. Today I want to buy the bike again. I have to pay 1,50,000. Suddenly taxes, some other values of components increased. So today's market price is what we call it as the current cost. Then another valuation for an asset is that, sir, that is okay. But this asset, today if you sell, how much you will get, sir? That is called realizable value, sale value, estimated sale value. I may get 1,10,000. How is that possible? You purchase for 1 lakh, can you sell for 110? Yeah, bullets are like that only, my dear friends. So bullet song, you know. So bullet is trending. So you know that already price, market price 1,50,000. Though I purchase for 1 lakh, there are several people ready to buy for 110 because in the market they have to buy for 150, and I have maintained this bullet very good manner. So people have different ambition to buy the bullet. So they might fetch 1,10,000. Present value means I use this bullet for raise and I will get lot of winning in cash. So next to 5 years, I'm expected to earn 80,000 for a period of 5 years. 80 means such benefits, I will discount it to the present using an appropriate discount factor. So that is called PV. PV means discounted value of future benefits. So question might give certain values of the asset, and they will ask you to identify different measurement bases as per the framework. So you have to identify these measurement bases, my dear friends. Framework taken for 4 hours. You're explaining in 25 minutes. Okay. The last component, my dear friends, concept of capital maintenance. Concept of capital maintenance. So capital maintenance means we expect, my dear friends, the business to maintain adequate capital at the end, which means their closing capital should be equal to opening capital. That's all we expect. Your closing capital should be at least equal to opening capital. I started business with 1 lakh. Now, at the end of that year, you should have at least 1 lakh so that your business is maintained. Capital maintained means business is maintained. At least, if not improvement, if not expansion, at least your business is maintained. That concept explanation now we are understanding as capital maintenance. So closing capital should be at least equal to opening capital, my dear friends. Suppose if I started with an opening capital of 3 lakhs, if I started with opening capital of 3 lakhs, I made a profit of say 1,50,000. I have made drawings of 90,000, which means what is my closing capital? 450 minus 90, it is 3,60,000. So under this capital maintenance, my dear friends, it explains financial capital at historical cost, financial capital at current cost, physical capital at current cost. 3 concepts it explains, my dear friends. Under this concept, they explain retained profit is equal to closing capital minus opening capital. So it is 3,60,000 minus 3 lakhs. So my retained profit is 60,000. So this particular concept says that your retained profit, if it is 0 or positive, it means you have maintained adequate capital. They will give you these numbers and they will ask you to comment upon whether the business have maintained adequate capital. In this scenario, you will comment that the business have maintained adequate capital. So 60,000 is there. Suppose question will ask you, how much more the businessman entitled to draw under this financial capital historical cost? What will be your answer? Your answer will be maximum it can become 0. So thereby the businessman can draw another 60,000. But anyway, that is a simple common sense. A businessman is allowed to draw up to profit. No, correct. So you feel it is a very, very simple answer. Yes, most of our accounting was based on financial capital historical cost. But we have financial capital at current cost. Financial capital at current cost. That will be slightly tricky. What is a trick? In a very simple part. Even at the end of the year, if you want to maintain same business, it is not sufficient if you maintain only 3 lakh value, because the value of 3 lakhs at the end of the year is not the same as at the beginning of the year. We had inflation. So we should use the index of opening and closing and adjust the expected opening capital or expected capital in relation to the opening capital. Once again, in relation to the opening, how much should be maintained at the end? For example, if you have opening index as 100 and closing index as 130, or I will take it like 125. Opening index as 100 and closing index as 125. Then I understand closing capital actual 3,60,000, adjusted opening capital. I should now take adjusted opening capital. What is that? It is actual 3 lakhs divided by index of 100 into 125. I think it is 3,75,000. It is 3,75,000. So I find I am having a negative 15,000. I am finding negative 15,000. Then what is the comment here? The comment is that the business have not maintained adequate capital. The business have not maintained adequate capital. What can be another comment? The proprietor or the businessman have drawn excess of 15,000, has made an excess drawings of 15,000. Suppose question may be some other way. What is another form of question? Now they will ask you, what should have been the drawings to ensure adequate capital is maintained? What will be your answer? What should have been? Already drawings is over. Drawing is 90,000. What should have been the drawings? By looking into this figure, how do you comment? Very simple. This is negative. What does the negative figure indicate? Negative figure indicate excess drawings. Upon you will tell drawing already made 90. This 90 includes excessive drawing. So drawing should have been only 75,000. Then the business can maintain adequate capital. Like that, you may have to make comments. This is the concept of capital maintenance. Whatever concept I'm explaining is there in the study module. Please, without fail, this framework you go through, my dear friends. Now come to accounting standard segments. Accounting standard segments. As far as accounting standard segment is concerned, I told you we have 8 standards. Now again a comparative study only. In December 2021, May 2022, we had in the first mandatory question, we had AS1, AS11, AS13, AS3. These were the questions we had. May 22, naturally I expected the other 4, and it was exactly the other 4. Exactly the other 4. You just make a comparison. I'm not just telling some statement which non-verifiable statement. You can verify. So it was, I said, I was predicting, or it's not a big prediction because it's just comparative study. So I was expecting AS2, AS12, AS10 and 16. So these are the standards expected in the mandatory question, and exactly it was same. Maybe in the same lines. Again, institute can give a shocker. So based on this 3 hours, based on Jason's revision class, I expected these standards. So don't expect like that. I'm just telling you, again, focus will be on to these 4 standards, or maybe few or majority of these standards, and combination of another standard. It can come, my dear friends. Anyway, we'll quickly discuss all the standards. But let me focus from a reverse viewpoint, my dear friends. So reverse look in this AS13 order, AS13, accounting for investments. My dear friends, AS13 primarily deals with accounting for investment. When we say accounting, it's about initial recognition. Initial recognition. Very first time investment comes into my business, what amount I should be recognizing it, which we normally call it as cost. Investments initially recognized as at cost. So in other words, what is the cost of investment? Then it will be disposed. So you buy, you sell, no. So there will be disposal, my dear friends. Disposal. So when you sell, what happens is that you will compare sale value and book value, and difference is recognized as gain or loss. Sale value means it is net sale value. Net sale value means sale value minus selling expenses. I've seen students know, usually they take selling expense. Expense should be added to cost, correct. But during purchase, it is added to cost. During sale, it should be deducted from sale value, because if I sell one investment for 500, And if I have to pay a brokerage of 20 rupees, you should know I am getting not 520. That's wrong. I'm getting 480. That 480 will be compared with book value. Will be getting profit or loss. Anyway, now between this period, it will be shown in the balance sheet. So in the balance sheet, is it the same value of initial recognition or some other value? Then we have a principle called valuation. So to speak, is it the same value or some other value? We have valuation. Valuation is depending upon, valuation has got some rules, is depending upon type of investment, which means for the purpose of valuation, we have an area called classification. Classification means segmenting the investments into different categories. Segmenting the investment into different categories, we call it as classification. So initially you assign the one investment into a particular category. Later on, can I reclassify into another category? Yes, you can. So for that, we have a reclassification principle. So from AS 13, and this investment is also separately covered in another chapter in module 3 as investment accounts in a detailed manner. So another 8-mark question will come from that. Preparing journal ledger, accounting standard does not discuss like which word to be debited, credited. Journal ledger doesn't discuss broad guidelines. So from that aspect, normally what is tested is valuation principle is tested, classification and valuation together is tested, reclassification is tested. So generally purchase of investment, sale of investment is tested through the investment account chapter. So my dear friends, when you buy an investment, it is getting classified into current investment and long-term investments, which is generally based on the time frame of 12 months. So if you intend to hold only for a maximum period of 12 months, which means if your intention to hold for a period not exceeding 12 months, then it is current investment, not exceeding 12 months. But exceeding 12 months, it is long-term investments. Actually, definition is intended holding period and not actual holding period. But unfortunately, studying and the examination question comes, it lacks clarity. Sometimes you have to react to it because in classroom they told like this, but examination, what do I do? You have to react. So what happened is that they gave date of purchase, they gave cost, they gave market price, they asked you to classify and value also, classify and value. But there no other choice left. You have to consider the actual holding period, and accordingly institute clarified that into current investment and long-term investment. But in practical, not only practical, standard says that it is intended holding period, which means even if you hold it for 1 month, even if you hold it for 1 month, it can be long-term investment if your intention to hold it for a longer period. That's a truth. That's a fact. It's a management who decide the investment is current or long-term. But unfortunately, in that particular question, there's absolute confusions there. But you should react when they give a date. Date of purchase given, balance sheet date given. Apart from the date of purchase to balance sheet date, see how many months. And if it is more than 12 months, you say it is long term. Less than 12 months, you say current investment. Current means, why should I do the classification? For the purpose of valuation. So for valuation, current investment should be valued at lower of cost and fair value. So cost or fair value, whichever is lower. Cost or fair value, whichever is lower. Fair value means generally market price. So normally we have technical definition. We spend a lot of time for technical definition. Exchange value between two knowledgeable billing parties, arm's length price. I don't want to create fear in you. So to explain fair value, it is market price. So cost or market price, whichever is lower, is what we understand as valuation for current investment. Long-term investment generally valued at cost. Sir, I purchase for 1 lakh. Market price 90,000. Doesn't matter. 1 lakh. Market price 70,000. 1 lakh. Market price 40,000. 1 lakh. So I don't worry about fair value if it is long-term investment. But sir, there is a reduction, and that reduction is a permanent reduction, sir. What do you mean the permanent reduction? In the foreseeable future, I don't expect this reduction to be reversed. So 1 lakh already becomes 60. Next year and all, I don't expect the 60,000 is again going to become 1 lakh. So it is a permanent reduction. Then if it's permanent reduction, then long-term investment will be valued at the declined value. Otherwise, temporary market fluctuations, we don't consider for long-term investments. But as far as current investment is concerned, 30th March, purchase for 1 lakh. 31st March, when I prepare the balance sheet, 90,000. And I know it's only temporary reduction. Next day only, again, it will become 1,05,000. So can I show this as 90,000 or 1,05,000? It has to be shown only at 90,000. Cost or fair value, whichever is lower. So that valuation based question can come from AS 13. So similar, so we have learned the classification, valuation, and another principle that can be tested from an AS 13 perspective could be reclassification. As far as reclassification is concerned, if the current investment reclassified into long-term investments. Another form is long-term investments. Originally long-term, now it is reclassified into current investments. So on the date of reclassification, the value should be assigned for the new category, new investment. What is the value? Now, current to long-term, it is again same principle of current will be applied for the last time. One more time we'll apply current order principle. Cost or fair value, whichever is lower. Cost or fair value, whichever is lower. If it is long term into current, my dear friends, then it is cost or carrying amount. You know, carrying amount means book value. Already the value which is there in the books. So cost or carrying amount, whichever is lower for long term into current. So current to long term, cost or fair value, whichever is lower. Just to demonstrate this, because you file is extremely easy, no? So just to demonstrate this, I purchased some investment by 1st March 2022 for rupees 3 lakhs. Now, 31st March, when I prepare the balance sheet, fair value is 2,70,000. And this was classified as current investment. So in my balance sheet, I will be showing investment at how much. You should apply your mind and tell the answer. Even if I am not seeing you, so I couldn't hear you. So seeing the system, you should answer. What is the answer? It should be valued at 2,70,000. 2,70,000 because it's current investment. Now, by 1st July, it was reclassified into. By 1st July, it was reclassified into long-term investment. Reclassified into long-term investment, 1st July 2022. So at that time, fair value is 2,90,000. 2,90,000. Apo, what is the reclassification value, or what is the value of reclassified investment, long-term investment? What is the value? You tell answer. Presuming many are giving correct answers, some of you may be going wrong. They may compare 2,70,000 or 2,90,000, whichever is lower. That comparison is wrong, because what is the principle? Cost or fair value. So this is only balance sheet value. This is not called cost. This is called carrying amount. This is not called cost. The cost is 3 lakhs. That will never change. The whatever amount you paid, no, that is cost. Even though you show in the balance sheet presently at 270, it is not the revised cost and all. Cost is always 3 lakhs. Now, first year balance sheet, you valued at 270, doesn't mean this becomes the cost. It is not cost. So it is 3 lakhs or 2,90,000, whichever is lower. In between balance sheet value shouldn't be considered, is what we should understand, my dear friends. So that way, the 3 lakhs or 2,90,000, today's fair value, whichever is lower, should be considered. The same principle will be applied there. Their cost, it is, suppose the same example, 3 lakhs, 2,70,000 long term. So when it is long term investments, and if it had been permanent decline, and you would have shown at 2,70,000, 2,70,000. So now today's fair value is 2,65,000. Today 2,65,000. Then you don't consider this today's fair value. You should take only cost or carrying amount, whichever is lower. For long term into current, cost or carrying amount, today's fair value not relevant. But their cost or today's fair value, carrying amount not relevant. This point you should know. This is the AS 13 problem areas. Purchase of investment, X interest, cum interest. Those areas presently we can't take in this 3-hour session, my dear friends. So we have X interest, cum interest, accounting and all. You should be knowing it. So you should be knowing how to prepare journal, ledger. Please definitely investment account topic will come for 10 marks. So in addition to that 10 marks, this question is what we are contemplating. I'm just focusing on accounting standard mandatory question. So AS 13 over no. So then in the reverse, I'll just quickly glance through AS 11, my dear friends. As far as AS 11 is concerned, there are 3 problem areas, my dear friends. One is accounting for foreign currency transaction. The other one is we have translation. Then we have accounting for forward contracts. Accounting for forward contracts. So, my dear friends, accounting for foreign currency transactions, translation, and then accounting for forward contract. I will tell you just quickly, I'll explain you 5 minutes each of this. So, when you have foreign currency transaction, the standard states that first, when you make a foreign currency transaction, for example, what is a foreign currency transaction? It means a transaction denominated in foreign currency, expected to be settled only in foreign currency by receiving foreign currency or paying foreign currency. For example, I am buying goods from a foreign supplier. He prepare invoice in dollar, so I have to give him dollar. Or I am selling goods to a foreign customer. Or I am taking loan from a foreign bank. These are all foreign currency transaction. A transaction denominated in foreign currency, receipt or payment expected to happen in foreign currency, my dear friends. In that case, the standard states that transaction initially recognized at the rate prevailing on the date of transaction. Transaction recognized. Transaction initially recognized at spot rate of transaction. What is spot rate? Mean that rate prevailing on the date of transaction. For example, I sold goods to a foreign customer. So entry is debtors to sales and it was $10,000. And this transaction happened on 1st March 2022. 1st March 2022. On that date, exchange rate was 80, 60 column puts gone or those days. Now 10,000 into 80, so it is 1 lakh, so it is 8 lakhs. So we make this entry. Then the standard state. So initially it is accounted like normal accounting entry. Standard actually not suggesting accounting entries. It's a quantification, measurement part. Then suppose you are receiving this $10,000 in another 10 days time. So for example, by 11th March, you receive $10,000 and becomes very simple. You receive $10,000. Imagine at that time 90 rupees you are getting as exchange rate. You are very happy. So bank to debtors, it will be 9 lakhs. So you are getting a gain. No, that gain should never be an adjustment against the sales. That gain should never be an adjustment against sales. That is an independent gain, should be recognized as a forex gain in the P&L. Forex gain in the P&L. For that, the standard explains like this. What, Abdina? Initially, you accounted the transaction. No. From that accounted transaction, if you have monetary items, such monetary items should be restated to the balance sheet. For example, if it is not settled on that date, expected to be settled by 1st May. So by 31st March, this monetary items. So question is, sir, what is monetary? I'm not understanding, I'm not following, sir. Very simple. Now, term monetary items means cash and bank balances. The standard explains this: money held, cash and bank balances. Other assets and liabilities that are expressed in fixed fixed and determinable amounts of receivables and payables. In other words, those assets and liability which represent receivables, fixed receivable, fixed payable, those amounts we call it as monetary item. Mind that it's only assets and liabilities. So in this transaction, sales, if I ask, is it monetary or non-monetary? To a student who have not learned previously, they will answer, sales are fixed amount is there, so it is monetary. My dear friend, sales is income. So income is not monetary. Income is not monetary, non-monetary. So only assets and liability can be monetary. So what are monetary item means? First, money held, that too money in foreign currency. Number two, you have assets and liability that are expressed in fixed receivables and payables. Okay, so thereby, in this example, sales is not monetary, debtors is monetary. So on this date, $1 equal to 84 rupees, which means debtors value, they are telling, should be restated to 8,40,000. Debtors value should be restated to 8,40,000, my dear friends. If that be the case, if debtors value should be restated 8,40,000, increased by 40,000, then debtors to exchange gain. Debtors to exchange gain. Like that, we should be accounting, my dear friends. And this exchange gain will be transferred to P&L of 21-22. It is transferred to P&L of 21-22. My dear friends, then on 1st May, you receive $10,000. Actually, you are getting $10,000. Equivalent rupee value on that date, $1 equal to 19. The entry will be bank account 9 lakhs. Bank account 9 lakhs to debtors. In your balance sheet, debtors is 8,40,000. 8,40,000 to exchange gain or forex gain 60,000. So the gain, total gain of 1 lakh is a portion between two different periods. Gain up to balance sheet, gain after balance sheet. In between balance sheet is not coming, no problem. Enter gain would have accounted in the previous year itself. Otherwise, the gain is getting apportioned into two different years. And not only it should be gain in 2 years, it can be gain in that year and loss in this year. For example, had the dollar value has become 81, then bank is 8,10,000, but debtors is 8,40,000, then you will book a loss of 30,000. How come loss of 30? Am I not having a gain of 10? Yes, gain of 10 is there, but last year gain 40,000, this year loss 30. Overall gain, if you see, there is a gain of 10,000. But like that, apportionment is required. For this, a standard prescribing these rules. What are the rules? Transaction initially recognized at the rate prevailing on the date of transaction. On the balance sheet date, monetary items, receivables and payables, not income or expenses, receivables and payables shall be restated to the balance sheet rate, So on the date 80 rupees, today 84, extra 4 rupees added to the value of debtors and booking a gain. That gain should not be adjusted in sales income. It is not sales income. Then on the date of settlement, the difference between balance sheet value and settlement value will be booked as further gain or loss of settlement period and not last year. It is the gain or loss of the settlement period. So like that, we are understanding, my dear friends. So this was basic accounting for this foreign currency transaction. So transaction initially recorded at spot rate of that date. Later on, balance sheet date restatement. Then at the time of settlement, some more gain or loss getting accounted, my dear friends. Okay. As far as translation is concerned, what exactly we are discussing now? We are a business enterprise operating in India. So we are operating in Chennai. So this is a business enterprise. Now this business enterprise is having a foreign branch. There is a branch, my dear friends, in US. Say maybe in New York, we are having a branch. Now this branch, my dear friends, in US, foreign branch in US, now maintains all the transactions, makes transaction, accounts transaction, everything in dollar, prepare trial balance in dollar. They make journal in dollar, ledger dollar, trial balance in dollars. And for their regulation purpose, they also prepare final accounts also in dollars. But this Indian company, when they prepare their overall financial statements, this branch information should also be incorporated. So thereby, those summary information in dollars has to be translated. So the translation rules only we are going to learn here. So for the translation purpose, the standard established translations applicable for or translations applicable in relation to a foreign operation. F4 stands for foreign operation. This operation can be a subsidiary, can be a joint venture, can be an associate, or can be a branch. Even though this foreign operation can be, foreign connection can be a subsidiary, joint venture, associate, or branch, but these three elements not within the ambit of our syllabus. Our syllabus confines to foreign branch. So this time, not only AS11, if you analyze the branch accounts as a chapter, last two examinations consecutively, they were testing stock and data system. So this time, again as a student, I give more preference to or more chances to either foreign branch problem or an independent branch problem. Either foreign branch problem or an independent branch problem. So RTP has given foreign branch problem. RTP has given, the latest RTP has given foreign branch problem. Please do solve it without fail, my dear friends. The latest RTP in my analysis, you should also done that. You would have already gone through. So suppose a foreign branches is giving its trial balance in dollar. About that information which is in dollar, my dear friends, we use exchange rate to translate into rupees. We use appropriate exchange rate. So what are all exchange rate available means we have opening rates, we have closing rates, the rate prevailing at the beginning of the year, rate prevailing at the end of the year. We have average rates. Then we have rate prevailing on the date of transaction. We call it as actual rates. So like that, we will have at an academic level, I am discussing here. So we have four rates: opening rate, closing rate, average rate, actual rates. Now for the purpose of translation, my dear friends, this foreign operation classified into integral foreign operation, non-integral foreign operation. We classify them into integral foreign operation, non-integral foreign operation. From the perspective of integral foreign operation, trial balance items we classify into monetary items, non-monetary items. For example, the trial balance has got land and building. What is that? Land and building, technical. It is non-monetary. It is an asset now, but that is not fixed receivable. Only if I sold the asset to somebody else, I get a right to receive money. So presently, it might have a market value or not. It is not representing a fixed receivable. I have assigned a value for it, that's all. So land and building, non-monetary. Plant and machinery, non-monetary. Vehicles, computers, furniture and fitting, all items are non-monetary. Investment in equity shares. Investment in equity shares. It is non-monetary because nobody have given guarantee that they will give this much money for this equity shares. Even though market price is there, which will fluctuate from time to time. It's not fixed receivable. But investment in bank deposits, investment in debentures of the company. So those things, we call it as the monetary item. So straight away, I can't tell investments now always non-monetary. Like that, we can't tell. Depending upon nature of investment, does it represent a right to receive fixed money, fixed amount? then it is monetary, otherwise non-monetary. Like that you classify. Stock. Some students are misunderstanding stock as monetary. Stock is not monetary. Stock is non-monetary. Stock is non-monetary. Debtors monetary. Bills receivable monetary. Like that, various receivables that you have will be understood as monetary. Similarly, my dear friends, various liabilities that includes outstanding expenses, salaries, all these things should be understood as monetary. Monetary. So like that, we have trial balance item classified into monetary, non-monetary. All the monetary items translated by using closing rates. Non-monetary item using actual rates. And if this actual rate is not determinable, then appropriate rate. For example, we have in the trial balance opening stock. We have opening stock. This opening stock will be translated by using what rate? Huh? This stock purchased in last year exchange rate. Don't know what. Then opening rate. Opening rate will be used. We feel appropriate rate for this opening stock is opening rate. Suppose if it is closing stock, even though today it is having stock, but purchased 2 months before, the 2 months before rate should be used. That actuals I don't know. Then appropriate rate for closing stock will be closing rate. Appropriate rate for closing stock is not average, but we usually presume FIFO, and accordingly we use closing rate. Just because of a closing stock, I use closing rate. Don't misunderstand that closing stock is monetary. Closing stock is not monetary. Closing stock is non-monetary. Hope you're understanding that. So similarly, for all the incomes and expenses, purchases, sales and all, standard have not told average rate. Standard says actual rate. And when the actual rate is not determinable practically, we'll use average rate. But for all academical purpose, we'll use average rates. Like that you translate back. So when you translate a tallied trial balance by multiplied by different rates, resulting trial balance will not be tallied. Will not be tallied because this number using one rate, another number using some other rate, now the resulting trial balance will not be tallied. And if it is not tallied, the difference is called forex gain or loss, exchange gain or loss. If the balancing figure you are getting in the debit, it is exchange loss. If the difference you are getting in the credit, it is exchange gain. Like that we are understanding, my dear friends. This is for integral foreign operation. If it is non-integral foreign operation, then we classify the items into P&L account items, balance sheet items, which means all the assets and liabilities, will be translated by using closing rate, which means land and buildings are closing rate, actual rate, closing rate. But if it is integral foreign operation, land and building, I should use actual rate as given in the question. Question should tell when was the land and building purchased and when what was the rate prevailing on that day. That rate should be used. Land and building, plant and machinery, furniture, vehicles, everything. Suppose by chance they have not given, I will use opening rate because I know it is existing at the opening from the previous year. I will use such rates, my dear friends. But if it is non-integral, then for all assets and liability, we use closing rate, P&L account items, actual substituted by average rate, and you will have difference. Which will be recognized in a reserve called foreign currency translation reserve. Foreign currency translation reserve. So based on this, you have RTP question. Please solve, my dear friends. I just given guidance to help you out. You will solve the problem and experience it and practice it for examination. Finally, forward contract. So when we discuss one standard, I take all the areas. I don't want to here and there take one or two adjustment alone, my dear friends. So in my coverage, if I take one standard, this 3 hours, at least that standard should be helpful to you. That is why we are taking every aspect of the standard. So in that process, if I omit 1 or 2 standard, then you have to study. For example, AS2, inventories. You can study on your own. Basic principle is what? Cost or NRV, whichever is lower. Cost means what? Fixed overheads, variable overheads, material cost. So material plus labor plus overheads. Overhead, variable, fixed. Depends upon the budgeted production and actual production. So those areas you should focus. So in the inventories chapter, my dear friends, solve problem, easy one. If you have already practiced costing, cost sheet if you know, then AS2 is nothing, my dear friends. Okay. So coming back to this AS11, forward contract, drink water. The last examination, we didn't have question from AS11. That is why I'm focusing this much for the standard. So this forward contract, my dear friends, means it's a contract for buying or selling foreign currency. I am entering into a contract with a bank stating that after 3 months, I will buy $10,000. So why should you buy $10,000, sir? Why do you buy currency? Because I have a need to give this currency to some other person. So thereby I'm entering into a contract. Now, you can buy at that time, no, sir. If you want to give the currency after 3 months, you can buy at that time. Why are you entering into contract now? It is because I fear this exchange rate keep on increasing. So government says that we will control and all. But 70 becomes 75, 78, 80, and it is going on. So I want $10,000. So maybe after 3 months, I find that I may have to spend 9 lakhs for it. I may have to spend 9 lakhs for it. So fearing that, I'm entering the contract with bank. Bank says, today enter into contract so that we will offer you for 8,30,000. We call this as forward rate. This is called forward rate, 83 rupees. We'll give it for 83. So which means in future, even if it is 90 rupees exchange rate, I can buy for 83. But the problem, you know what? If it is 80 also, I have to buy for 83. If it is 90 also, I have to buy for 83. In the market, if it is 80 also, I have to buy for 83 because it's not an option contract we are discussing. We are not discussing an option contract, we are discussing a forward contract. So you understand what is forward contract? A contract to buy foreign currency or sell foreign currency. Now, this contract may be for hedging purpose, may be for speculation purpose, may be for hedging purpose or speculation purpose. You know what is hedging means? Protecting against some risk. What risk is that? I know after 3 months, I have to give $10,000 to one of the foreign supplier. At that time, I may have to spend 9 lakhs. So fearing that only I enter into contract to buy this $10,000 from a bank. So that even if that exchange rate becomes 90, I will pay rupee note of 8,30,000. I will get $10,000 and I give $10,000 to the foreign supplier. So in this whole process, my cash outflow was 8,30,000. My cash outflow is 8,30,000. But if I didn't enter into this contract, what would have happened is that the potential loss, that there is a huge loss, no, that 1 lakh loss, that is today it is 80 rupees and future is becoming 90. Now that 1 lakh loss, I may have to incur. But today you don't have loss, sir. If I enter into this contract, you don't have loss. I have. How much? Today rate is $1 equal to 80 rupees. Bank says you sign contract now, will offer at 83. So here what happens now? My loss is arrested. So hedging is a contract entered into either to avoid the loss or reduce the loss. Either loss is completely avoided or at least loss is reduced. So for that we are entering into the contract. Now if today's rate is 80, bank is offering 83 now, then my total loss is arrested to this 3 rupees. So 10,000 into 3, 30,000 loss only I have. So the standard says that the difference between spot rate and forward rate is recognized. If the forward contract is for hedging, loss is arrested. In future, even if the market rate is 100, $1 equal to 100 also, I am least bothered. And if it is 80 now, if it become 80, 75 now, I am not bothered, but slight pain will be there that I have to buy for 83 rupees. I can't enjoy this particular benefit. That's okay. I am fearing not about loss of profit. I am fearing about huge loss in future. So thereby, I want to protect against my loss. That is what hedging contract. In that case, coming back to this, difference between spot rate and the contractual rate. Forward rate is nothing but contractual rate. The difference between these two recognized as discount or premium. Discount as, recognized as discount or premium, which is deferred and amortized. Deferred and amortized over the contract period. Over the contract period. For example, this contract is from 1st March 22 to 1st June 2022. Now, it is for March, April, May. In that, March falling in the current year, April, May falling in the next year now. So then, out of 30,000, 10,000 loss will be accounted in the current year and 20,000 loss will be accounted in the subsequent period. 20,000 loss will be accounted in the subsequent period. If you enter into the contract of, option contract of hedging. Speculation. What is speculation? I don't have any foreign currency commitments. Absolutely no commitments. I chumma enter into contract. Just like that, enter into contract. Thinking that I can buy for 83 and sell in the market for 90 rupees. I can buy for 83 rupees and sell in the market for 90 rupees. Like that, I am planning. So bank is offering me, today you sign the contract, we'll offer you at 83 rupees. So I have to buy. And if in the market, if it becomes 75, no, then it is a loss to me. But if it is 99, it is going to be a gain to me. So which means in this exercise, I will have gain, I will have loss. And it is not going to be freezed. Suppose suddenly my exchange rate become $1 equal to 40. In the dreams, it's not dreams. We will make it happen. Suppose suddenly happen to 40, no, I will have huge loss because I have to buy for 83, sell for 40. Either way, suppose $1 becomes 140 by any chance, na, then I buy for 83 and sell for 140, I will have a huge gain. Apo, difference between the contractual rates and rate prevailing at the end of contracts. Spot rate at the end of contract. Here spot rate at the beginning of contract. So here spot rate at the end of the contract. So those two rates will be accounted as gain or loss in the settlement period. Fully, it is not amortized and all. It is fully recognized as gain or loss in the settlement period. So we have three rates. 1st March 80. Then on the same 1st March contractual rate, this is spot rate, 83. Then on 1st June, some rate will be there. No. So say 1st June, it is 90 rupees. So here, if it is a contract of hedging, I should book difference between these two only. This I will not consider. 1st June spot rate. 1st June spot rate, I don't want. So 3 rupees. And this also will be deferred over the period of contract. Suppose entire contract falling in same accounting year, no problem. But if it is falling in 2 different years, 3 months, 1 month this year. So 1 rupee this now, this year, 2 rupees next year. Like that will account. But if it is contract for speculation, difference between these two rates. The contractual rates, this is irrelevant for me. So 83 rupees and 90 rupees, that becomes relevant. That will be accounted as gain or loss in the year of the expiry of contract, in the year of settlement. Like that, you should know the distinction for treatment of hedging contract and speculation contract. This much only we can convey. in a short period, because a standard that taken for 6-7 hours, we can't do that elaborate in a 3-hour session. Okay, so with this we are concluding on to one of the very important standard from the coming examination perspective also, AS11. AS11. Next, we have the standard. No, AS1, I don't want to take anything and all, because primarily AS1 discuss about fundamental accounting assumptions. So, which is again going concern consistency accrual. If you follow, you should not disclose it. You need not disclose it. If these are not followed, disclose the fact that they are not followed. Disclose the fact that they are not followed. Similarly, accounting policy means what? Means significant accounting methods adopted to achieving significant accounting principles and methods adopted in achieving such principles. Both together we call it as accounting policy. In 2 attempts back, no, they were giving true or false. They give 5 statements about AS1. You need to make true or false. So you simply glance through. That is not something to be explained in a classroom level. Even a regular class, we spend only 45 minutes for AS1. So you can glance through AS1, my dear friends. If any question comes from AS1, you can easily answer. Sometimes they will ask you, what is the notes to be given in relation to AS1? AS1 does not involve any numbers. It's just a theory standard. Please glance through. Takes 10 minutes, 15 minutes for preparation, though we discuss for 45 minutes. So AS3 cash flow statement, you should know what are operating cash flow, investing cash flow, financing cash flow, cash and cash equivalents, purchase of asset, sale of assets, investing cash flow, borrowing money, repaying money, both from external debt providers and also owners. Both are financing activity, day-to-day business activity, normal course of business activity. We call it as operating activity. You know, it's a big chapter this time. Now it's I'm telling this. So last time or last 2 times, cash flow statement did not have a very big presence in the examination. December 21, only 5-mark question. The last examination, I think around 8-mark question came. This time there is a chance a 15-mark question can come. A very good quality question can come from the cash flow statement, or they might surprise you with financial statement of company. This also did not come for the last 2-3 examination. Financial statements format. Understand the format of the balance sheet asset, equity and liabilities. Under that you have shareholders funds, share application money pending allotment generally won't be there. So something not there, you need not write that and nil and all. So non-current liabilities, current liabilities, under that the inner breakup. So similarly assets, non-current assets, current assets. Under non-current assets are various components. So this format you should be knowing, because the financial statement of companies comes now, you don't have complicated adjustments. It's just that you should group into different categories. That's all. Trial balance doesn't have groups. When you prepare balance sheet, sometimes P&L, you have to group them with providing adequate notes to the balance sheet, notes to P&L to be presented. So this is also high chance of coming in the coming examination. Last 2 examination, in my analysis, I didn't find a question from significant contribution from these 2 chapters. Unlike other chapters where profit or loss paid incorporation, never imagined. I, as a faculty, never imagined for 20-mark and all, but it came. So similarly, redemption of preference, debentures, etc. together came for 20 marks. So this time, potentially, this is an area so you have to focus by solving problems, more of indirect method problem. So the general sources can be the last 4 RTPs. The last 4 RTPs. From that, all the cash flow statement, financial statement, not only these 2 chapters, all the questions from all the chapters for at least 4 RTPs, maybe 3 suggested answer. Next, remaining whatever days that you have, very limited days you have, no. If you can complete that, definitely that is more than sufficient. With general understanding about all the chapters, problem solved from all these sources, RTPs and 4 RTPs and at least 3 suggested answers. It will be good if you add 1 or 2 mock test papers of ICA also. Serious effort is taken by ICA in conducting mock tests. So if you can cover up these problems, general understanding about all the chapters, it is more sufficient, my dear friends. Okay. Again, since I switched to this segment through AS3 cash flow statement, one of the question can be tested, or I expect personally from an coming examination perspective, analyzing different papers. So again, it's only a common sense analysis. What now? Valuation of rights. Valuation of rights. Last 2 examinations we did not have. So you know how to value your rights, my dear friends. Very simple. So you know what is rights issue? Rights issue means shares issued to the existing shareholder. Company issue shares, get money, company formed. Whenever company goes for a subsequent issue, generally preference is given to existing shareholders. Generally preference is given to existing shareholders. So they can contribute the cash, get the shares, so that their shareholding is not diluted. Otherwise, their percentage of holding will be diluted. Presently, company has got 1,000 shares held by 10%, each holding 10%. Now I want another 1,000 shares to be issued. If I issue to third parties, then 2,000 shares, you will be holding now not 10%, your percentage will be now become 5%. So thereby, if you want to hold the same ownership, so you may have to buy the shares. So thereby only we give preference to you. So we have a concept called valuation of right shares. For how to find out valuation of right shares, it is very simple. Come right price of share, minus X right price is what we call it as value of right. Come right price minus X right price is what we call it as value of right. Not understanding, sir. Very simple part. Suppose one shareholder holding 500 shares, whose market price when he acquired, including it is called as come right price, market price. Come right price, the price just before the rights. The price just before the rights. So market price, my dear friends, is say 80 rupees. 80 rupees. Now, rights issue or rights entitlement, it is 100 shares. Rights entitlement to this Mr. X is 100 shares. Since he is having 500 shares, he can buy another 100 shares by payment of rupees 60 for each share. By payment of rupees 60 per share, he has to pay 60 rupees. Okay. Therefore, the computation of the right value will be, first we should find out X right price. This is called theoretical X right price. Same principle in group 2 will apply in AS20 computation of EPS. In that, to find out bonus element in rights issue, we find something called theoretical X right price. You know that itself sufficient. That's a concept we're going to apply. What is it? Now, presently my wealth. What is my present wealth? 500 into 80 is my wealth. Now, if I buy this rights, then it will be 100 into 60. It will be 100 into 60 is the new addition to the wealth, divided by how many shares that particular wealth is getting apportioned to. Now, it is 600. So 500 into 80, it is 40,000 plus 6,000 divided by 600. So 46,000 by 600. So 460 by 6. 6 sevens are 42. 40. So 6 6 are 36. Again 40. So it is 666. Again it goes. So 76.66 is called X right price. Expected price after rights. So how to calculate X right price? Present wealth. How to find out present wealth? present number of shares into present market price or market price before rights plus the payment for rights, which is number of right shares into rights issue price. So the total money divided by, how do you got 600, sir? Originally I'm having 500. Now new rights 100, totally 600. You get this X right. But before rights price was 80 rupees. After rights expected price is 76.66. So value of right is 80 minus 76.66. It is 3.34 rupees or 3.33 rupees. This problem area, it can come in the coming examination for a 5-mark question, my dear friends, or a general bonus issue related entries. You know, bonus issue generally paid out of CRR, then securities premium, then general reserve, P&L account, capital reserve is also available. Generally 5 sources we will see. 5 sources. First we will say CRR will be used, securities premium will be used, capital reserve will be used, general reserve will be used, P&L will be used. So if a question comes from CRR, various reserves, if a question comes from bonus issue, entry, journal entry for bonus is very simple, is that reserves debit to bonus to equity share capital. So like that you make simple entry. These reserves will have to be identified based on the information given in the question. So like that, standard and this module 2 simultaneously we are taking together, my dear friends. So we completed AS 11, we completed AS 13. We also discussed few things about AS 3, AS 1. Other 4 standards, it is not that won't come. It can come out of the remaining 4 standards. 2 standards can come in the question number 6. So AS2. So I wanted you to analyze. So take care of the area where treatment of fixed overheads. So if actual production is greater than budgeted production, actual production less than budgeted production. So just quick telling you, understanding something is not required. Spend some time onto this area. Maybe 15 minutes you spend, learn this area in the valuation of inventory. This could be an area of testing from AS2. We have AS10. AS10, there is one area, my dear friends. So there are so many areas. I can't take the entire standard because AS10 alone we used to take for 12 hours in a normal class. So now I can't discuss everything, but I'll just tell you one thing. Initially, property, plant and equipment recognized initially at cost. What is cost? What and all not cost? What are directly attributable expenditure, trial run cost, interest, everything to be added. Like that, one problem area is there. So to know what is cost, there is a problem area. Okay, that is initial recognition. Subsequent recognition means I purchased at that time what value. Subsequently, when I prepare the balance sheet, at that time what value. Either you follow cost model or revaluation model. So this revaluation based question tested in the last examination. So presently, I don't want to discuss the revaluation entries or treatment of revaluation profit or loss. Revaluation profit means revaluation reserve. Revaluation loss means P&L. But this area has been tested. Then another area is there called subsequent expenditure. Subsequent expenditure. So if you have a subsequent expenditure, my dear friends, this expenditure will be identified as day-to-day service cost. Day-to-day service cost. Repairs and maintenance, always expensed. Replacement of major parts. One more minute. Generally, earlier to AS10, you know what happened is AS10 revised earlier, some parts replaced. Then we will question, does that increase efficiency of the asset? No, then expensive. It will increase efficiency. Yes, it is capital. Like that, we had a scenario. Now it is not like that. If it is major part of the asset, then it has to be capitalized. If you are replacing the major part of an asset, then it has to be capitalized. It has to be capitalized. It cannot be expensed. It cannot be expensed. Okay, so replacement of major parts. In the RTP based question, this is there. So that I want to focus on that particular thing. So an asset which was having a cost of say 50 lakhs. This is not the number in the RTP. RTP has got different numbers and different questions. Now this is having a life of 10 years. This is having a life of 10 years. Now after 2 years, one part was replaced. One part was replaced. So cost incurred now, it is 20 lakhs. Cost incurred now is 20 lakhs. Cost included on purchase, was 15 lakhs. Cost included on purchase is 15 lakhs. The question was, what is the book value of the asset by end of year 2? What is the book value of the asset by end of year 2? This was the question. So we understand like this, my dear friends. First of all, book value before replacement is cost 50 lakhs. Accumulated depreciation for 2 years is 50 lakhs divided by 10 into 2. It is 10 lakhs. So presently book value is 40 lakhs. Now as per AS10, if a major part is replaced, the amount spent as on today should be capitalized. So what is the amount spent today? What is the amount spent today? Cost incurred now. Cost incurred now is 20 lakhs. So that has to be capitalized. So cost of replaced part. Cost of or new part of the asset. 20 lakhs. Similarly, the carrying amount of the old part replaced shall be derecognized. It means eliminated. Shall be eliminated. So carrying amount of the old part replaced shall be derecognized. So how much abdina? It is minus carrying amount of old part. How that has to be found out? Further they are telling cost included at the time of purchase was 15 lakhs, but you should not deduct 15 lakhs. So you should be careful there. Already 2 years depreciated. No. So today what value including 40 lakhs? So that value you should deduct. So 15 lakhs minus depreciation for 2 years. 15 by 10 into 2, it is 3 lakhs. So 12 lakhs derecognized. So 40 plus 20, 60 minus 12, 48 lakhs. Only example number, similar number you have in RTP. Please solve this question from AS10. So it comes from the area called replacement of major parts. So in replacement of major part, new part cost should be added and carrying amount of old part replace shall be derecognized, and that problem has been given in the RTP. Please do solve without fail, my dear friends. AS10, that is the area I wanted to discuss. Revaluation discussion, I don't want to make it. Similarly, the problem areas other than these two, if at all you want to learn, means what is cost? What is cost in case of acquired, self-constructed, exchanged? Similarly, revaluation entries for profit or loss. Profit means revaluation reserve, loss means P&L. But subsequent revaluation treatment is depending upon what is the previous revaluation effect. Suppose firstly you had loss, then it is P&L debit. Next you have profit now. Usually revaluation reserve, but standard says no. You had loss in the past, So reverse the loss. So credit P&L. Further profit, you credit revaluation. So those areas we just glance through, not so important, but this is very important. What I have covered just now is very important. from an AS10 viewpoint. So I have discussed quickly AS1, policies, fundamental accounting assumptions, etc. Change in policy related disclosures. AS3, cash flow statement. Understand about classification of cash flow into operating, investing, financing, and cash equivalents, meaning what? Because if you have made FD, fixed deposit in your bank, can I say it is cash equivalent? Then we understand generally no, because only demand deposits with the bank or cash balance. Cash balance means cash in hand, and cash at bank in demand deposit. Demand deposit means only savings account and current accounts, not term deposit, not FDs. But this FDs having a maturity of 3 months, then it is cash equivalent. Then it is cash equivalent. So because short-term investments highly not having any risk of change in value, then it can be considered as cash equivalent. Those definitions you should see. That way AS 1, 2, 3 we discussed. Valuation of inventories. So the fixed overheads treatment you should be aware of, my dear friends. So then we discussed AS10 just now, AS11 completed, AS13 completed. Other two standards are AS12 and AS16. So I'm just giving that segments to you, my dear friends. So borrowing cost and the government grant. Okay, maybe just two minutes I will explain. It's already 3, close to 4. By 4:45, I want to shift to the presentation segments of the paper. As far as AS12 is concerned, my dear friends, government grant means what? Government is giving you money. We call this monetary grant. Government is giving you some other assets, non-monetary grant. So there are 2 grants. So accounting for government grant depends upon whether it is monetary or whether it is non-monetary. And if it is monetary grant, the government giving you money. For what? Government is giving you money in the nature of promoter's contribution. An established business wanting to start a new unit of business at one place, another place, notified area, wanted to start a new business. At that time, for the entire new business, the owners only should bring money. If the government says that no, in that area alone, if you start business, if the total funds requirement is 80 lakhs, we will give 20 lakhs. We will give 20 lakhs. So like that government is giving money now, it is a part of owner's contribution. So actually owner should bring money. So out of the owner's contribution, a part is shared by government, but not getting ownership. Government doesn't want ownership. Government is giving free to us. But this is not for a particular purpose. The government is not giving this money for buying a particular asset. Not they saying that it is used for so and so purpose and all. For the entire business commencement, you need 80 lakhs. We will give you 20 lakhs. So we will give 25%. That is 20 lakhs. Then that is called in the nature of promoter's contribution, which the business should always credit to capital reserve. Government grant received by a business in the nature of promoter's contribution. What is that? If I want to start a new business in the notified area, so then I'm getting some money from government for commencement of that overall business. Then that is called in the nature of promoter's contribution. I should credit to capital reserve. Government is giving money for purchase of asset. Government is giving money for buying a particular asset. Not for starting business at one location. The government is giving money for buying a particular machinery, particular building, particular some other asset. Okay, solar plant, etc. In that case, if it is a depreciable asset. So if it is depreciable asset, then there are 2 treatments we have. There are 2 treatments. Either the money received can be deducted from the value of asset and reduced value will be depreciated, or asset will be maintained at the same. Grant received will be booked as deferred income in the balance sheet liability side, and every year asset will be depreciated to debit side of P&L, and this deferred grant income from balance sheet liability side will go to P&L credit side. Both will have same result only. Both will have same result. I purchased one asset for 80 lakhs. Government is giving me 20 lakhs. So revised value 60 lakhs. Now 5 years life na, every year I can depreciate 12 lakhs to P&L depreciation. This is one approach. Another approach is asset share, so 80 lakhs, deferred government grant 20 lakhs. Now you depreciate divided by 5. So 16 lakhs will go to P&L depreciation, and this will come as income proportionately over the period of 5 years, over the period of the asset. So government grant income, so 4 lakhs. So to that extent, this will be reduced. This will become minus 16. So this becomes 64. You reduce 4, this becomes 16 lakhs. So net effect, if you see, you will find same 12 lakhs. Like that, you have option, my dear friends. Treatment of receipt of government grant. Treatment of receipt of government grant. If the grant is for some, not for buying asset, for some revenue related activity, for providing free vaccine to the family members of our employees. Free vaccine I am provided to family members of all our employees. 5,000 employees, each family has got some 4 members. So 20,000 people can given free vaccine. Government appreciating this and giving me some money. So that grant is called revenue grant. Such revenue grant will be automatically taken into P&L as income. So only thing is, if the revenue grant is for past services, now fully it is credited in P&L as other income. If it is for future services, now then how we discuss for asset, same way we will take it into balance sheet liability side, and every year it will be amortized over such period of service, over the period of service. Like that, we are understanding accounting for receipt of grants. Refund of grants is exactly reverse. Exactly reverse. So at the time of receipt, if you are reduced from the value of asset, at the time of refund, it should be added to value of asset. At the time of receipt, if you have credited capital reserve, then at the time of refund, capital reserve is debited. At the time of receipt, if you have credited P&L as income, then at the time of refund year P&L shall be debited. So exactly reverse. This is the treatment of government grant for receipt and refund. So please solve problem from that standard also, because though I said 4 standard key, but other standard also can come, because it is not only in question number 1, question number 6 also will have a lot of relevance from accounting standard. A16 is qualifying. I mean, borrowing cost should be capitalized to the qualifying asset. So general borrowing, specific borrowing, that one problem area is there. It is already tested. So I don't want to discuss further into A16 and all. So with this, I'm completing on to module 1. Simultaneously, I also discuss for module 2. So one more time, I'm telling you for module 2, my dear friends, cash flow statement, financial statement of companies. Last 2 times, managerial remuneration in case of profits, managerial remuneration in case of losses, both have been tested. So it could be financial statement of companies, a complete balance sheet problem can be tested, or cash flow statement can be tested, my dear friends. So mostly I'm expecting an indirect method problem here. So financial statements a complete problem. Sometimes dividend payment out of reserves. In your study module, there is one question based on dividend payment out of reserves, where you are supposed to satisfy 3 conditions. So what are 3 conditions? When you pay dividends, the sources are generally current year profits. Current year profit not there. Last year P&L balance not available. Now I have to use general reserves for payment of dividend. Then 3 conditions. Maximum dividend is only past 3 years average. Past 3 years average. Similarly, the amount you can withdraw from reserves is only 10% of paid up share capital plus free reserves. Third, minimum retention. Minimum retention. So minimum retention, that is you withdraw, but after withdrawal, general reserve should have some money left. So how much now? It is 15% of paid up share capital. Paid up share capital. So you should ensure these three conditions cumulatively satisfied in payment of dividend out of reserves. So this is company law rules. So this rules testing is done through a problem in the study module. Please go through that also. Okay. Bonus entries I conveyed. Rights, the valuation of rights problem I solved. Redemption of debenture chapter we can't take. So investment accounts and debenture are almost equal topic only. X interest, cum interest. You need to be really aware of those concepts, my dear friends. When you have own debenture purchase and cancellation, etc. So that you have to spend time. We can't explain you the chapter now. It has been 8 hours, 10 hours revision class. That is different. But this chapters you can go through, my dear friends. Now coming to third module. In the third module, my dear friends, we have 6 different chapters. Insurance claims. Starting with insurance claims. My dear friends, when it is insurance claims, you have loss of stock, loss of profit. So we normally identify 4 steps here to compute the claim, my dear friends. What are the 4 steps there? It is first thing is you should identify gross profit ratio. So if it is already given in the question, no problem. So simply GPR mentioned 30%. Now you should always understand it is already on sales. But if they say it is GPR on cost 30% now, then it should be converted as 30 by 100 on cost equal to 30 by 130 on sales. 30 by, what is the basic understanding? Very simple. If 100 rupees is cost price, 30 is profit. Now selling price is 130. That's also 30 by 130 on sales. So like that you have to, suppose GPR not given now, you may have to prepare trading account of previous year for which information will be given. Fire occurred this year. Actually, I want to prepare this year trading to find out how much stock I had just before fire. Further, I want very important information. Actually, I want to prepare trading account, we call this memorandum trading up to fire, in which I will take opening stock, purchases, sales, and GP, so that closing stock is balancing figure, representing stock before fire. For GP, I want GPR, sales into GPR. That point only we should focus first. So if GPR not given, we should prepare trading account of previous year, arrive GP, then GPR is GP by sales into 100. Like that you should apply, my dear friends. So once that is over, then this particular stock on, you should find out loss. Loss is nothing but stock on date of fire. Stock on date of fire minus salvage value. Stock on date of fire minus salvage value. We usually say it is salvage value retained, which means if you are given some stock, the insurance company back, then that stock should not be taken. So it is stock on date of fire minus salvage value retained. So which means by preparing the trading account till the date of fire, we have how much stock just before fire. After fire, we understand this much has been saved. So balance is what I have lost. Simple common sense. Now, there is something called computation of claim. For that, we should compare policy amount with compared with stock on date of hire. So, if this policy amount is equal to or more than stock on date of hire, no problem. But if it is less than stock on date of hire, Then we will apply something called average clause. So claim is equal to loss into policy amount by stock on date of hire. Only thing is compare policy amount not with loss. This comparison is wrong. Compare policy amount with stock on date of hire. So we expect you to take policy for all the stock present in the shop and not for the loss suffered at the time of hire. Nobody can predict the loss. So you need to insure the entire stock. So like that, 4 steps. Step number 1, ratio to be identified. Given a happy, not given a last year trading account. Similarly, if the business has got some abnormal goods, then in presenting the trading account, if it is for finding GPR, such abnormal goods eliminated, such abnormal goods eliminated in finding gross profit, because I want margin only in relation to normal goods, margin only be required. But if you prepare memorandum trading and you have abnormal goods, then we will have separate columns for normal goods, abnormal goods, because we expect both to be compensated, but both have different basis of measurement. So thereby we use separate columns for normal goods, abnormal goods. So present RTP is based upon this normal goods and abnormal goods based problem. That is why I thought of just touch upon that particular segment. So then you should add both the stock on date of hire equal to stock normal goods as well as abnormal goods. Both should be considered, my dear friends. Okay. So this is for loss of stock. As far as loss of profit is concerned, very simple, my dear friends. You should first identify the compensation period. After fire, some months I could not do normal sales. So during that period, since I don't do sales, I lose profit. That profit will be compensated. So thereby, my dear friends, it is I should find out how much sales I am losing. Further, I should compare same period in the last year and any trend is there for increasing or decreasing. So I will get expectation of current year. Then because of fire, I did little sales. I deduct that balance is what I have lost. Suppose sales of last year during compensation period, not entire 12 months. If it is 3 months or 3 months, 4 months or 4 months. Compensation period. Plus or minus trend. Plus or minus trend will give expected sales. Minus actual sales will give me the sales which I have lost. We call this as short sales. On the short sale, we will apply GPR. We'll get the profit on sales lost. Profit on sales lost. So when you apply this GPR, GP is equal to not the normal ratio that we use. It is net profit plus insured standing charges. Anybody hearing for the first time these terminology, I don't know, they cannot understand. Those are already prepared, they will remember these things. So it's only a revision, not teaching. Okay, I guess we're cold now. So net profit plus insured standing charges, my dear friends. So that way you will identify last year net profit, last year insured standing charges, add these together, you will get gross profit expressed as a percentage on sales, GP by sales. In loss of stock we use GPR, no, that is different. And GPR we use in this policy, loss of profit policy is different. You should bear this in your mind. Then we will also have a claim for some additional expenditure. So you just glance through how to calculate, because I feel explaining these things in a hurried manner will not do any value addition. So in the flow of things, I understand that, I get a pulse like that. So additional expenditure claim. So GP on short sales additional expenditure claim together should be added. From this, some expense, if it is getting saved, savings in insured standing charge is deducted. So we will be getting gross claim. Then policy amount will be compared with one number called GP on AAT. So which is called adjusted annual turnover. So you will have something called annual turnover, that is sales during 12 months immediately preceding the date of fire. Fire occurred on 1st March 22 now. It is 1st March 21 to 28th February 22. This is what we call it as AT. Then on this AT we'll apply trend. We call this AAT. On AAT you multiply by GPR. You will get GP on AAT. So that GP on AAT should be compared with policy amount. And if this policy amount is equal or more, no problem. If policy amount is less than, again you will apply average loss. So net claim is equal to gross claim into policy amount divided by GP on AAT. So these are all steps that we devise by discussing a lot of common sense in a regular class. And this is not regular class, just a recap of the various steps involved in the computations, my dear friends. Okay. So in the investment account, insurance, that's it. In the investment account, as far as investment account is concerned, we have already discussed AS 13 related classification, valuation, reclassification. When you buy investment, it can be fixed income bearing security, variable income bearing securities. Fixed income bearing, variable income bearing securities. So fixed income means income is fixed, variable means income fluctuates from time to time. Example, equity share. This is debenture, bonds, etc. Okay. So you're buying this, you should know one thing. Under both the scenarios, we actually pay money for two things. We are paying money for two things. Investment we are paying, we are also paying money for some income accrued. If it is fixed income bearing, now it is in interest, variable, now it is dividend. So we are paying money for income. So our outflow comprises of money for investment, money for income. When it is fixed income bearing securities, this income is determinable at the time of purchase. Suppose, my dear friends, we are buying this debenture on 1st July. And the investment we are buying is relating to a company that pays interest every 31st March. So April, May, June, some person was having this debenture, but this 3 months interest he is not going to get, because he is selling that investment to me. So since he is selling the investment to me, he is holding for 3 months from 1st July 2022 till 31st March 23. 9 months I am holding, 3 months he was holding. He deserved 3 months interest, I deserve 9 months interest, but the company doesn't pay 3 months and 9 months interest. Company paid 12 months interest to me. So thereby, at the time of buying, I have to pay 3 months interest to the seller. So thereby, entry will be investment debit, interest debit to bank. For how many months? This interest calculation is very important. So two rules should be applied for interest calculation. Rule number 1. Interest should be calculated on face value. Investment purchased for rupees 105 per debenture is only a purchase cost. It should be calculated on face value. Face value, say it is 100, will be given the question. So interest should be calculated on face value, number 1. Not on market price, not on purchase price, not on cost. It is always on face value. Interest should be calculated from last interest date to the date of transaction. I hold for 3 months, 9 months, that is irrelevant. Last interest date to the date of transaction. When was the last time that company paid interest? So that company paid 31st December, sir. Oh, then Jan, Feb, March, April, May, June. 6 months interest I should calculate now. No, sir, that company paid interest 31st March, sir. Oh, I should calculate for April, May, June, 3 months interest. So last interest date to the date of transaction, I should calculate. These two rules apply and calculate interest. Question will give transaction as X interest or cum interest. X interest means the amount given in the question does not include interest. The amount given in the question does not include interest. So it is for investment. So amount given in the question, write against investment. Interest independently calculated. Together you write against bank. But if the question says purchase for 3 lakhs cum interest, write 3 lakhs against bank. Interest independently calculated. Investment value will be balancing figure. So like that, you should know the difference between X interest, cum interest. One more point you should remember is that brokerage, if any, should also be added to the cost of investment. Brokerage, if any, should also be added to the cost of investments, my dear friends. So that also you should remember when you buy. In the bonds, one doubt will come. Sir, in the brokerage given the question, sir, it is given as 2%. Now, this brokerage I should apply on cum interest price or X interest price, sir. Should I apply on cum interest price or X interest price? Question will give direction. Question will tell brokerage at 2% should be applied on cum interest price. Brokerage at 5% should be applied on X interest price. Like the specific direction given, you follow the direction. If no specific direction given, then you should see how the transaction is quoted. If the transaction is X interest, apply brokerage on X interest price. Question is not telling brokerage is applied on X interest, but this question says purchase X interest for 3 lakhs, then brokerage apply on 3 lakhs. So it is purchase on cum interest for 3 lakhs, then apply on 3 lakhs. That's all. Whatever amount given in the question, on that amount, apply the brokerage. If there is no specific direction, so I'm getting confusion, sir. I'll tell you. Suppose question says brokerage should be applied on X interest price. Specifically, they are telling 5% should be applied on X interest price. But transaction, they are telling 3 lakhs cum interest. 3 lakhs cum interest. In such problem, you should deduct interest portion on this amount only. You should apply 5% brokerage. 5% brokerage is what we are telling. Apo, when will I deduct this interest and apply 5% brokerage? Only when the question says brokerage apply on cum interest price. Suppose question says brokerage is apply on X interest price. Brokerage is applicable. I'm sorry. Brokerage is applicable on cum interest price. Like that's conveyed. But transaction is given as X interest. Transaction is given as 3X interest. Now what I should do? Should I apply brokerage on 5% on 3 lakhs? Question says brokerage should be applied 5% on cum interest price. Cum interest price. Now what I should do? I should apply 5% on 3 lakhs. 3 lakhs X interest. What I should do? Compute interest. Add. So 3 lakhs plus 6. Otherwise, I should apply 5%. This is the point I was explaining. As direction given in the question, follow the direction, and wherever required, add interest, deduct interest, and calculate. Suppose direction not given, then what amount given the question? As it is, X interest amount, cum interest amount. Like that, you should apply, my dear friends. Is what you should consider, my dear friends, for applying this brokerage. Okay. Then if it is equity shares, this segregation of cum interest, X interest will not be applicable, my dear friends. So at the time of purchase, entire amount paid for shares will be capitalized as investment value. You will have investment to bank entry only will come. Only thing is when you receive dividend, dividend will be classified into pre and post. Pre-acquisition dividend is recovery of cost. So thereby deducted from investment cost. and post-acquisition dividend is income credited in P&L, which means if I receive dividend for 22-23, I receive 12 months dividend. In that 12 months, 3 months I was not holding. Then how do you got dividend? Company will pay 12 months dividend to me only. I understand. 3 months is relating to pre-acquisition period. 9 months is relating to the period after my acquisition. 9 months I deserve, but they give me 12 months dividend. I receive 12 months. Bank 12 months. Credit investment. 3 months I account as recovery of investment cost. So credit investment 3 months dividend. Credit dividend account transfer to P&L 9 months dividend. Like that we should account, my dear friends. This was the various other accounting relating to investment account, my dear friends. Hire purchase chapter. Hire purchase. So I already conveyed that branch accounts focus on independent branch problem, foreign branch problem. Foreign branch related discussion I have already taken through AS11. So that way we have already done that particular segment, my dear friends. Hire purchase problem. Hire purchase chapter, my dear friends, you have hire purchaser, hire vendor. Concept is what? I am buying one asset and the consideration I am paying in installments. I am not getting immediate ownership, I am getting ownership towards the end. Even though this is the form of the transaction, but if you look into substance, actually I am taking a loan from the vendor. So suppose asset value is 80 lakhs or 10 lakhs, just 10 lakhs. First time getting a loan for 10 lakhs. So that loan again I'm paying to him and I'm buying the asset. So this was actually an outright purchase. It is an outright purchase with the help of a loan, So thereby, this is accounted as per AS 19. So this 10 lakhs worth of asset and I am purchasing, and over the period of 4 years, I have to pay 15 lakhs, which is called HP price. So this asset in my books will be recognized only at 10 lakhs. Asset will be recognized only at 10 lakhs, my dear friends. So to liability or hire vendor, this is called cash price. Cash price, na? If I have money now, and if I want to buy now the asset, I have to pay totally how much means it is only 10 lakhs. So thereby asset is debited at cash price. The difference between these two is nothing but interest. This interest will be accounted over a period of time. Suppose out of 10 lakhs, if you pay any down payment, say 1 lakh, then I make the entry, hire vendor to bank. Down payment, 1 lakh, 1 lakh. The difference between this 10 lakhs and 1 lakh is called principal portion. So what is principal amount means? If you analyze the substance of the case, I need 10 lakhs money, but I have 1 lakh in my pocket. So balance only they are giving me loan. So 9 lakhs is the loan. So cash price minus down payment is what we call it as the principal portion, on which interest will be charged. So interest rate will be given. You should apply on 9 lakhs. For example, if it is a 20% means, so out of 15 lakhs, you are paid 1 lakh. No. Balance, imagine you are paying 3.5 lakhs each. So totally it is 15 lakhs. So 1 lakh it is paid. So balance 14 lakhs you are paying in 4 years, 3.5 each. You will be calculating interest on what amount? On 14 lakhs or 10 lakhs or 9 lakhs. And the interest is calculated only on 9 lakhs. Principal portion. What is principal? It is cash price minus cash down. Cash price minus cash down. Upon 9 lakhs, I pay interest at 20%. We make the entry as interest to hire vendor, 1.8 lakhs. How do you get 1.8? 9 lakhs to 20%. These are all assumed rate only. So it may not match with the proper accounting, or at the end of 4 years, it should become 0. Here, these numbers are assumed numbers to explain the entries. Later on, we make hire vendor to bank 3.5 lakhs. But what happens? Opening principal was 9 lakhs, interest 1.8, 9 plus 1.8, 10.8, minus 3.5. So this becomes 7.3 lakhs, 7.3 lakhs. Next year, I will charge 20% interest on the 7.3 lakhs, on the 7.3. So how the upon liability at each year is decided? Opening amount plus interest minus installment. So closing principal. Opening principal plus interest minus installment will give closing principal. So in hire purchase chapter, since mechanical entries, what mechanical entry? Interest due, interest to hire vendor. Installment paid, hire vendor to bank. Interest transfer to P&L. Depreciation also charged by the hire purchaser. So mechanical entries are involved. So generally they don't test you journal entries and all. They will test you calculation. Computation of say HP price. Computation of HP price. Computation of installment value. Installment value where it is equal, where it is unequal. Computation of cash price. Computation of cash price. Computation of interest when interest rate given, interest rate not given. Like this, these are the problem areas, total problem areas. If at all you have not compressed the chapter, this is the problem areas in hire purchase chapter. Apart from this, accounting for repossession. Accounting for repossession. This much only hire purchase chapter. So, what is hire purchase price now? It can be expressed as cash price plus total interest, or it can be expressed as down payment, immediate payment and installment payment, immediate payment and installment payment. Like that, this HP price can be expressed. So computations only for 5 marks. Regular HP price is tested. Sometimes when the problem involves repossession, then the question can come for 8 marks. HP at a very, very high level, it can't come. But again, institute, I don't know whether they will shock you with 20 marks. Very, very remote. So HP price understood. Installment value, if it is unequal, I will just explain how to calculate. Here, interest payment, installment, then we have principal outstanding. So year 0, commencement of the HP contract, we will have cash price should have been given minus cash down. Then by using the rate, we calculate interest. By using the rate, we calculate interest. So interest at a particular rate, on this amount, we will be calculating interest amount. Then if the question says principal is equal payment, means this principal divided by number of years will give you principal repayment. So in that case, interest with the principal give you installment. So here what happens now? Principal same now. So which means principal same now. Principal same means installment will be different. Why? Because interest in each year is going to be on the reduced principal. On the reduced principal. So that way we'll be calculating installment. One more time, what is installment now? Each year interest with the principal payment if the principal payment is equal. But if the question says equal annual installment, equal annual principal illa, equal annual installment, in that case there is a formula application. It is principal, that is cash price minus cash down divided by annuity factor. Very quickly I spend time on to these two problem areas, but somehow my mind says It's again not 7 cents. Analyzing the question papers, I find that the other two areas could be a potential problem area this time. Computation of cash price, where installment 1, installment 2, installment 3 given, cash down given. So in how to solve such problem now? Though again there is an FM technique of doing this, but we can't expect FM technique answer to be given here. Institute expect you to give the calculation that will sync with the ledger account. What we will do now, it is year 3. Suppose only 3 years, now year 3, 2, 1. So what we will write is liability outstanding at year end after installment. Then installment. Liability before installment. How this calculation? After year 3, it has to be 0, no? Because 3 years, the higher purchase contract, after year 3, it should be 0. So here given year 1, year 2, year 3. Year 1, 1 lakh. Year 2, 1,20,000. Year 3, 1,50,000, like that given. After year 3, you have paid 150. That is why it become nil. Before payment, 1,50,000 is outstanding. Reverse calculation. Third year end, it has to be 0. It is after paying 150. Before payment, it is 150. Outstanding. Before payment, outstanding is 150. You paid 150, thereby it becomes 0. Now this 150 comprises of opening balance plus interest. But suppose interest is, my dear friends, it is some 14% means this represents 114. So what we will do is that suppose you want interest also means 1,50,000 divided by 114 into 14. You don't want interest now. 1,50,000 divided by 114 into 100 is the opening outstanding at the end of third year. I'm sorry. Opening outstanding at the beginning of third year, which is end of second year. This number comes here. Then this number plus second year installment, which is already paid, say 1,20,000. After paying this, this is outstanding now. Before payment, this amount plus this amount is the total outstanding. And this represents 114. What is 14? What is 100? Like that, reverse you should be doing. You have practiced it. This is an important examination problem area. Another one is calculation of IRR. Highly potential examination question this time. Calculation of interest rate, which is nothing but IRR. What is that? Rate at which installment, if discounted, equals cash price minus cash down. That is rate at which installment, if discounted, equal to principal portion. This IRR computation, you will not have trouble. Your IRR random numbers are no. Question will give you PV factor for 2 different rates. Question will give you PV factor for 2 different rates. So using these 2 rates, discount the installment values and see how it can be brought to principal portion. Interpolate and arrive at the IRR is also another problem area, my dear friends. Please solve that particular question. Because repossession and subsequent repossession problem tested in the last examination. So highly expected question from this departmental. All the examination we are having an 8-mark question. Simple trading P&L question usually come, but this times I consider like no 2-3 times since that question did not come. Managerial remuneration based on departmental profit is also highly expected because of again thinking that last 2-3 exam we did not had this. So managerial remuneration based on departmental profits. So you have stock reserve. not considered in departmental profits. So you should consider. So when you consider, remember, the stock reserve should be considered only in the transferor departments and not transferee department. Suppose you have 4 department A, B, C, D. A transfer to C, A transfer to D, B transfer to C, B transfer to D. So managerial profit should be adjusted. Now you should adjust only A and B's profit and not C and D's profit. So that problem is also there in the study module. So please solve that problem also, my dear friends. So that is what highly expected from module 3 perspective. So with this, an expected questions, or you would say important areas, pure student approach of comparing past examination with current examination, but that is a silly silly prediction. But we have, through that process, we discuss several chapters concept, we discuss several standards. So with this, you can start preparing the exam. Now I will tell you, we have 4:41. We can spend 10 minutes, 2 segments I will do. If I'm a student, my dear friends, what I will do for the remaining days. So we have hardly like today 14, 17 days home. So I will not try to now do systematic approach for all the chapters and all. As I told you previously, if somewhere from your classroom notes or from some videos, if you can understand basic concept of each chapter in 30 minutes, just rush through your notes, classroom notes, then solve 2 to 3 RTP questions from that chapter, preparation should be over. Don't try to solve all the questions from your workbook, classroom notes, etc. and all. Classroom notes, chuma glance through, solve all the questions from last 3-4 RTPs, my dear friends. At least the last 2 RTPs, my dear friends, should be the general source for preparation. Accounting standard question should be at least from, though we are telling, even if you cover 2 RTP questions from all chapters, accounting standard question, if I am a student, I will cover 4 RTPs and 4 suggested answers. Minimum I cover these 2 for accounting standard, because 30 marks. And how many times institute, no, though we tell the questions won't be repeated, but these are all same principle which are not getting changed for several years. So thereby, institute know the choice left, again should come back to the same type of questions only. But naturally, it can be only from these areas the question can come. Here and there, surprise element will be there. But during this last few days, I would prefer these institute resources, RTPs and suggested answers should be the key for your preparation, my dear friends. Then maybe the latest MTP, mock test papers conducted by the institute. Extraordinary effort taken for 2 test series, mock test 1, mock test 2. So those papers, if you can acquire also or take up the test also, it will be wonderful, my dear friends. Okay, so this should be the source for your preparation. Now, in the examination, my dear friends, so if I'm a student, learn concept insurance claims, just run through the concept for 30 minutes, solve 2 questions here and there, 2 questions, chapter is over. Investment the same, every chapter like that only. Focus branch, foreign branch problem and independent branch problem, my dear friends. Okay, accounting standard, all the 4 RTPs, all the 4 suggested answers. In the examination, on the day of examination, my dear friends, when the examination is 2 to 5, during that time, daytime, I will go through only accounting standard question. I won't try to solve a comprehensive question. 20 mark question I will never solve, at least after 10 o'clock at least. So before 10 maybe. So that I don't want to solve. If that question comes and if it because of that, I won't be failing on that. So I will simply glance through all the standards problem because that is the first question. Okay. So that is normally what I do. I'm just giving my opinion now. This is not mandatory that you should follow. So I'm reading, I went to the examination hall. So I am not here to explain you for 20 minutes, like, how long, how many hours you should go to the examination hall, take your pencil, pen, rubber, check your hall ticket. I respect you all, know you're a professional student. So such things will be very silly if I start explaining those things and all. It shouldn't be explained to you. It's like insulting. So I won't do that. So examination hall I went, I got the exam question paper. I'm reading for the first 15 minutes because we get 10-15 minutes before the writing. I get the question paper, start reading it. I select that question. I select that question to write first. The question that I know very, very well, I feel extremely confident, which could be question number 5B also, no problem. Doesn't matter. Sir, can I write like this 5B and then 5A? Yes, no problem. Center of the question paper, no center of the question, not somewhere in between where you tag it or pin it, not somewhere 5B like this. I will write properly question number 5B. It's a duty of the examiner to follow my order. So people will tell like, no, don't follow that or this. I want the first question to be a pick from the examiner. Many times we have to play psychologically. When I correct papers, so many papers I correct. I find 5 students who wrote the first question wrong. 6th student automatically, even though I should be professional enough, but 6th student, the moment I notice, wrong only. So that thing will come. So thereby, I want it tick. I want it tick for the first question what I write, my dear friends. Okay, so first question should be really a well-known question, confident question. And preferably the question does not involve balance sheet, because unfortunately balance sheet is not telling. Accounting is the first paper. We all will be nervous whatsoever we'll tell. No, don't fear here. What is the need for fear, etc. and all. Now, if I'm thinking like an intermediate student, now which I'm getting the fear. So on the day of examination, naturally fear will come, nervousness will come. So you need to really take a good breath, a glass of water, and then the first question, with a lot of calmness and confidence, you write, it has to be a tick. So this is the first point I want you to understand. Suppose. My dear friends, in your reading, just few other things what I noticed on the students is that, suppose by reading it, accounting standard came totally unsurprising question, surprising question, like no shocking questions came. You don't know it. So, okay, you feel like accounting standard, you don't know. You read the second question. When you read the second question, you feel like, no, that is also, it's like some tough single entry. You read third question. Unfortunately, that is also very tough. Immediately, I've seen students who are giving up. I am not telling this should happen to you. Everything should be easy to you. My dear friends, when you go to the examination hall, you should have a lot of confidence in the perseverance, the strong self-confidence. Imagine the fourth question will be easy, but by the time you have read 3 questions, you felt absolutely demoralized. 60 marks gone. No, 60 marks not gone. Still 65 marks is there. Another 65 is there. At least 60 is there. So you can fetch a lot of marks from it. Question number 4 is easy, but mind is not working. Question number 5 is easy, mind is not working. 6 is easy, not working. In that 60, definitely there is a chance you could have secured 50 plus, but mind is not working because you get demoralized. So don't do that. Don't do that. Be calm in any situation. So even if out of 125, I'm telling you the mentality of the students is that 25 marks very tough. 100 marks out of the 50 very easy, 50 medium. But students are worried about those 25 which was very, very tough. And they will make a judgment. They will immediately form a pakka networking related the information they will share. Paper is untouchable. It is never like that. Okay, so never like that. So you should really be calm. Take that question, even if it is the 5th question, part B only, you are knowing the best. Go to that question, attempt it. First few questions you are not knowing also. Later on, when our nerve settles, then our brain start functioning, it will give answers. So initially, when you think about the answers, sometimes few chapter doesn't work. So some chapter you work, proceed, naturally you will get it. So that is number one. Number two is that, my dear friends, accounting paper generally felt by the students as lengthy paper. Rather than lengthy, I would say lack of practice by the students. And thereby in the examination only, they will make it, no, they want to make it so legible and neat. I would tell you, do not try over to make it so legible. So you have a handwriting now, make it readable form, that's all. Don't try to write. See, these are scribblings my students usually manage. Now in the examination, this I can change maximum to this much level. So I don't want to make it as a flowery handwriting. So this can be written in a readable form. I don't want to make it in a flowery form in the exam. Don't try that. Extra, neat handwriting, extra marks is not there. Similarly, taking pencil, drawing the ledger accounts, not at all required. Please don't do it. Don't take scale only to the examination. You think that you want to take scale, no, don't take scale. The taking scale only tempt you to draw line like that. Draw like this. I'm teaching accounts for the last 18, 19, 20th year now. Never the ledger account lines are straight for me. So am I really worried about this? So why are you worried about that straight lines and all? So don't take scales and all, my dear friends. So people usually tell, take this, take that and all. I'm just telling you, don't unnecessarily spend time onto these things which doesn't add any value to your paper, my dear friends. With the pen only underline, with the pen only draw lines. Don't take pencils. Pencils are not allowed. So don't do that, my dear friends. So if you're unsimilar, next thing is that students spend a lot of time in thinking, writing less. So whatever you think, keep putting into writing, my dear friends. Every writing only will fetch marks. Examiner doesn't know how long you were thinking to arrive at the answer. In accounts, my dear friends, there is few facts I want to share is that there are several students who have acknowledged, which I have experienced in my life. My juniors I have shared, so many students I have shared, they have acknowledged it also. There are times where 100 out of 100, which means all the questions I have answered, all the questions, final answer wrong. Final answer wrong. What do you expect in such a scenario? So we expect 10 marks or 15 marks out of 100, and there are students who fetched 63 marks, 59 marks out of 100. In such scenario also, it is applicable exclusively for accounting, my dear friends, because your paper, when you read the question paper, it is question number 4, A, 12 marks, B, 8 marks. Question number 5, 20 marks, like this one. But the same answer sheet given to the examiner for correction, then it will have maybe 6-7 breakup. 2 marks for this step, 1 mark for this step, 2 marks for this step, 3 marks for this step. This is how it has been. Every step fetch you marks. Every step fetch you marks. So thereby, I want the students to provide as much workings. A simple calculations also do it in the working. So that even if your main solution, final answer is wrong, it's okay. For each of the workings, there will be a lot of accumulation of marks, my dear friends. So when there is a single entry problem, trading account, GP wrong, net profit wrong, balance sheet total, because of this, balance sheet total is not correct. But this single entry problem supported by 7 to 8 workings. So for what I need workings? Very simple. Any number which is not there in the input as a question, which is not there in the question, number you are using in the solution, that number, how do you got, has to be explained, is working notes. Maybe like it is 4,000 plus 3,000. Sir, my brain can do this 4,000 plus 3,000, 7,000, sir. But I want you to put that as working note because 7,000 is not a number given the question. That is there in the solution only. So how do you got 7,000? Please explain. It's not how you get number. Others reading the answer should know how you got 7,000. So thereby, my dear friends, sound is getting affected. So please provide as much workings. Whenever you find there's clarity missing in the question, you know what is the title? First instruction to the question paper: make suitable assumptions wherever required, appropriate. And the people who are correcting are sensible people, and they know, like, oh, this is the assumption you take. So based on that, I will correct and I will give you marks. So thereby, good professionals only correcting the paper. So please dare enough to make assumptions, not making assumptions your mind and not writing it. So whatever you assumed, okay, this is the fact, I understand. So you make the assumptions very clear. So in the presentation, my dear friends, few things. First, it should always be solution. Question is asking you only P&L balance sheet, but I need to prepare trading account, but trading account is working note because the question is not asking you that. So what is question asking you? It is solution. Then followed by working notes, my dear friends, followed by working notes. And in the solution, everything should have cross reference. So suppose you have a number which is there in working note number 3, tell that it is there in working note number 3. Because these working notes are not for your purpose to find out the number to be taken. It is for somebody else's reference. So your audit opinion or any other reports is actually prepared for others' purpose. Financial statement is not prepared for your benefit, it's for others' benefit. So thereby, you should know how to present it on a professional manner. Working notes, making adequate working notes, cross-referencing to the notes, assumptions presentation, and showing all these things at the end of the solution or at the beginning of the solution, very much required. Then mantra for my successes, or mantra what I always believe is that instead of attempting extraordinary 60 marks, I believe average 100 marks is better. So last 1 hour, assess. Even if you completed after 2 hours only 45 marks, 1 hour, the remaining 55 is possible. I am of Dhoni's brand. So initially, took da, and at the moment I know it has slog over started, then I will complete it. Though we take deep into that last minute also, but we'll try to complete it. So completion is very, very important. So you should never say, sir, 5 marks only I left there, 7 marks only I left there, 3 marks only left. No, 100 marks attempt should be the mantra, my dear friends. So at any stage, at least 2 lines about that question which you intend to omit should have written, fetch you 1 mark, which can change your career. 59, getting 60 instead of 59, or getting 40 instead of 39. All these things plays a very, very, very important. Or aggregate marks, 199. There are several students. So thereby ensure that attempt 100 marks, my dear friends. Okay. So keep calm in examination. Definitely nervousness will be there. Fear element will be there. But once you start answering the best of answer, automatically be settled. Always take good breath. Have settled. Read the question second time. Don't have biasness towards reading the paper. And attempt the paper, my dear friends. Those who are prepared sincerely, definitely you can give the best attempt, my dear friends. All the best. Hearty wishes for your examination. Once again, thanking the SICASA for giving this opportunity. So we would like to now end the session. Thank you.
Thank you, sir, for briefing overall chapters in the accounting paper and also giving very good presentation how to approach the paper also. Yes, sir. I hope every students get a maximum benefit out of it, and also SICASA believes for that too. Yes, sir. Thank you for giving us your availability. Thank you, sir. And also I will conclude this session by giving vote of thanks. Thank you, sir, for your availability, Mr. F Jaison, sir, and also SIRC, and also SICASA, and also thank you, sir. We can conclude it.
Oh, thank you. Bye, friends. All the best.
Sir, and also I would like to mention that not necessary. Tomorrow there will be 2 to 6 p.m. session, direct tax and indirect tax, 2 hours each, and I will request all the students to make benefit out of that also. Thank you, sir. Bye.
All the best.